What was the beginning like for Andrew growing up on a farm in North Dakota?
Yeah. So I grew up middle North Dakota, basically in the middle of nowhere. 6 siblings, Kylie being one of them.
Yeah.
And family farm. I've always been interested in like money and investing. I mean, when I was like 10 years old, I started doing puts and calls and running the grain cart and just kind of learning everything about the grain market. And by the time I was 14, I started trading stocks, and that's when everything crashed. I mean, my 14th birthday in March 23rd, I think the market bottom, I think it was like March 5th, like that month. So just that was luck. That was just lucky timing.
Yep.
I had $4,000 saved up, and I turned that to $80,000 in like, I don't know, a little over a year. And that was buying Ford at 99 cents, Bank of America at $3. I mean, that was just a crazy timing. And then that's what got me into real estate. So when I was about 14, 15, I just cashed out my 80 grand, and we were renting my parents' and grandparents' equipment, farm equipment, hauling it to South Dakota to custom combine. And we were heading through Bismarck back to the family farm 3 hours north of there. And I saw these apartments for sale. And when I was in South Dakota custom combining, I was reading a lot about history of, in the 80s, the oil boom and real estate price patterns. Williston first, Minot second, Bismarck third. And at this point, the oil boom was kind of coming back. Mm-hmm. And the same pattern was happening. Williston, Minot, and Bismarck wasn't quite hit yet for valuations adjustments. And so I found these 2 apartment complexes, $1.25 million roughly, if I remember right. I had 80 grand. I put a purchase agreement in. I was like, 15. Didn't know what a purchase agreement was. Didn't know what escrow was. Learned it all on the fly. And signed the papers. Went back to my small town of Mulhall to the bank. Buddies of mine's dad was a loan officer. And I'm like, hey, I need, whatever it was, easy math, $1.2 million as a loan. And, here's 80 grand down. And he's like, Andrew, you need a balance sheet. I mean, you're not even old enough. Like, you have to be 18 or older, right, to close on these things. And so I was going to give up. I'm like, okay. So I left. I called the broker. I'm like, hey, like, it's not going to work. He's like, there's no refunds. Like, this is hard. This money's hard. I was like, oh, shit. Right. So that's when I then went back. I'm like, okay, got to figure it out. So that's when I went and started knocking on doors and finally found someone. I'm like, hey, I'll work for free. If we lose anything, it could be my $80,000 first. Mm-hmm. And so he's like, okay, like, this is it's real estate. It's a hard asset. This kid's going to work for free. I got a cushion on the value. It's, it's apartments. So he gave me 300 grand, his PG, we bought him. The oil boom did hit, and we made about $1 million profit in, I think it was like 16 months. And then I'll stop there if you want to dive in deeper anywhere. So that gets me to about 18, 17 at that point.
So what year were you born then?
94.
94, okay. So you're what, 31, 32?
Yeah, 32.
32. And then what small town were you from?
Lansford, North Dakota. So we're between Lansford and Mulhall. So you'll hear me reference both, but.
Sure.
What was it like going door to door and trying not only to, like, some people sell, windows or they sell shoes or whatever it is. Like, what was it like trying to sell a $1.2 million apartment deal?
It was, I had a little track record, but that was obviously luck. Like, hey, I turned $4 grand to 80, and a 15-year-old, 16-year-old, whatever it was, putting in $80,000 into a real estate deal. Mm-hmm. That was an easy selling point a little bit, right? That's pretty impressive. But it was hard, but it wasn't, I think it was like my 5th door I went to, and I got the 300,000. I think every door I went to, I had to evolve the plan. That was a learning lesson, is like, your offering is going to kind of dictate the easiness of selling the deal. And so what I mean by that is, like, my offering got better as I went. Every door I went to, I made it a little better. So by the time I got to the door that said yes, I was to the point where I was literally saying, yeah, I'm working for free. My 80 grand first out will be 100% mine. Like, I knew eventually I'd create a product that would be appetizing to be bought.
Sure. Are you still doing deals with that same, was it a farmer? Or?
Yeah. He's been still involved.
I bet he is.
It's been a journey.
That's hilarious.
A good one. Yeah. Our shares in, like, just for context, like, our Abernathey Holdings, our shares were about $8 in 2012. And, today they're about 80 to 90. So about 20% compounding return, average. And there's a lot of different stories and deals and some failures. through the way. But
so you're not publicly traded. This is a
not
private.
yet.
This is a private capital deal. You raise money. Guys buy shares. I mean, it'd be like a REIT essentially then.
Yep. No dividends. So we've never done dividends. So that's where the REIT status is not there. Permanent capital vehicle, kind of like a Berkshire Hathaway's that's my mentorship, my model. And public is in our future. I think we're set, like 2034 would probably be my goal to go public at my 40th birthday. We got about 150 shareholders now. We're still private, of course, but there's three reasons to go public outside of ego. But the right three reasons is access to capital, liquidity, using your shares as currency, and then liquidity for investors, and raising capital will be the third. So those three things we never really had an issue with, but I think it would be nice to just have the world price the shares. I don't really enjoy that part. There's a formula to it, but I would rather just not be part of that and just let the world do that part.
And how long ago did that happen when you started opening those shares up to buy? I mean, because you're 18 years old here.
Yeah, so
I guess we're kind of cutting you off. You can keep
you're
going.
good. Yeah, very good question. So back up. So that deal was done, and it was just the two of us. Had about $1 million in cash. $380,000 of it was mine, and that's when I went and was like, okay, I want to go raise some money. So I was like a senior. Went to my family lawyer. I'm like, I want to raise $10 million. And he's like, I'm not in securities law. So he pulled out his legit paper black book and was like, you need to go meet with this lawyer in Fargo. So I drove here in my Lumina, 5 hours away, went up, met with this attorney. He taught me what a PPM was. He taught me what a 220, 2% management fee, 20% profit share, hard hurdles. I learned all of this in that meeting, and we set it up. And I went. It took me about 12 to 15 months to raise another $10 million, and that was kind of when Abernathey Holdings officially was born. And that initial raise, I probably brought on about 20 shareholders roughly.
What were you raising for?
Blank check fund. It was, I did this, then the real estate. I am now, here's my mentor and my mental model. And I'm going to go find the next thing.
So you did one apartment deal that turned off.
Yep.
Which, whatever, I mean, you could chalk it up. You said maybe luck, maybe it was whatever got you there.
Yep.
And then you just asked for money and they gave it.
Yep. That was, and farming was good. I mean, at the end of the day, like, access to capital is really when you want to be in the right area at the right time with the right people. So like farming was the best it's been in 50 years. Every door I knocked on, it was a $50,000 to $1,000 to $100,000. And I went to 4 doors a day. Like, there's a time to raise money in a place, and there's a genre of people too. And so I was at the right place at the right time where people were willing to spend $50,000 to $100,000 to take a bet on a local kid that had a little bit of a track record. But yeah, that was the gist. Raise some money and let's go see what I can do with it.
And then what were some of the first projects that you remember deploying that capital?
Yes, I remember I was actually surprised I raised it too. Right? I mean, you set this big goal and you're like, I'm going to raise $10 million. And then like I did, I'm like, oh, shit, I actually raised $10 million.
Now I got to do something
with it. Now I got to do something with it. Now the real work starts, I mean, raising money is not it's not like a success. It's not like a celebration. It's an obligation, right? And so a lot of people celebrate when they raise money. For me, I'm like, okay, like I now have an obligation. Like that's when the real stress and the work starts. And so I called all the brokers in the Midwest, and I was looking again for these companies that were between $1 to $3 million. Had high return on capital deployed, like a Warren Buffett play. Had somewhat of a moat. Hopefully 20 plus years of track record, so I could underwrite it properly. And I got a call on this equipment dealership out of Great Falls, Montana. Never been there. So I jump in my car, drive 12 hours to Great Falls.
Not the Lumina?
Yeah, not the Lumina.
Okay,
I had a red car at that point.
Okay.
Yeah.
Okay.
I don't think the Lumina would have made it.
Yeah.
And get there, talk to him, shake his hand, I get the deal done. So the first deal was $3 million, 3.2 million down, 2.2 million seller financing, 20 years, 4.5% interest, no personal guarantee. And I bought this municipal equipment dealership that's been around since 1949. And that was my first deal. Learned a lot of lessons. It's still in operations today. We went from about 3 million revenue to we're about that 16, 17 million revenue now.
Wow.
But I did overpay for it. a real business is a business that you can take the CEO and pull him out and the business doesn't fall apart. Mm-hmm. This was a business where he was the business. And I paid for it as if he wasn't. Now, obviously, we had a success story, but I probably overpaid a bit for it. And the second mistake I made was I didn't have anybody lined up to run it. The second we closed, he's sitting there training me in. And in my head, I'm like, this isn't my plan. Like, I want to be Warren Buffett and have presidents and like a diversified, decentralized, holding company. So I was like, crap. Like, I really messed up here. So I scrambled. I was there for 3 months. Finally met someone that was a referral from someone else. He drove up, hired him. Him and his team have single-handedly brought it from where it was to where it is today. Luke Stewart. And so thankful. But that really could have went south. Mm-hmm. Those are two big mistakes. And we luckily have done really well with the investment. But I learned my lesson from those. And I have many more mistakes, but that was 2 on that deal.
Out of that initial $10 million raise, how many guys were part of that?
So our average check size then was probably 200 to 250,000, so there's probably 40 to 50 people that were investors at that point. We've tripled our investor size since then, but we've raised, well over $100 million since. And, our last valuation from our offering was about $250 million for holdings, which is a fun story from 4,000.
Wow.
I'm really excited to cross $1 billion, and then I'd love to hit $1 trillion, before I die if I can live long enough. Probably have to live about 94 at 15% compounding.
There you go.
But
did you have any? You said you kind of follow like the Warren Buffett method and Berkshire Hathaway. Did you have a direct mentor that was helping you with a lot of this stuff once you actually gained capital and were starting to come up in the world?
Yeah, my dad's always been a big mentor, and my mom. My mom on the social charisma, heart side. My dad on the mental model side, grit, hard work. And then that evolved to when I was like 19, I was out here, went to college here in Fargo, lived here for about 8 years full time. I made a list of the top wealthiest people in North Dakota, which most of them are out here in Fargo. Mm-hmm. And I called them all. And some of them called back, and we chatted. I was very fortunate. Gary, the wealthiest man in the state, called me back, and we went and had breakfast. And at the end of the day, I just wanted to learn. These individuals love to tell their story, love to give advice. And as long as you're someone that can leave the meeting or breakfast or whatever you kind of call it and go and do it and have actionable items and bring back a report card, that to them is unspoken respect. And they will continue to invest in you. And so very fortunate, Gary took me under his wing at a young age, and now we have a decade-plus relationship. And so he's been a really big mentor of mine. And then I've got, of course, a bunch of mentors I've never met, Buffett and Carnegie and, Vanderbilt and all the greats in history.
Yeah. That's something we've had to learn too with like talking to guys that they get a charge out of helping a young guy out.
Correct.
And everybody's so terrified of like, oh, they're on a different status. And it's like, they're just guys like me and you. You could be worth $1 trillion, you could be worth $10, and we're just going to be sitting here having the same conversation. Yep. But yeah, talking to those guys and hearing their stories. And I like what you said about bringing them a report card or talk. It's kind of that unspoken because they don't want to just tell you something and then you do nothing with it. That's a waste of everyone's time.
Because those meetings will stop with that.
Absolutely. But for you to turn around and, like I said, come back or bring them an idea or anything at that point, and to hit the top tier from North Dakota right off the bat.
That's crazy.
Chalk it up to a win. That
was wild. And I think that's just like, talk to people. Don't be afraid. Like that was the lesson there of just really proud of myself to have, again, like my mom gave me that, like just the no fear, charisma, like just do it. At the end of the day, like what's worse that could happen? It's like asking a girl on a date, like whatever.
Right. Whatever.
We live by that. If they say no, it's like, okay, well, out. I'm still out nothing.
Exactly.
We've had so many people ask us, like when we started this podcast, like how do you get Rick Berg, Drew, how do you get all these people? Like we literally sent them an email or we literally called them, and almost every single one of them is like, yeah, I want to share my story and I want to help you guys out. And they get a kick out of that. So it's funny that you did the same exact thing that we're doing now.
Yeah. Which is the best. Like some people look at youth as a liability. I think youth can be an asset.
Without a doubt.
It's all about how you spin it and carry yourself. That's you guys are doing it, so I know you agree.
Yeah, because you do. I love you said that, an asset instead of a liability, because you do get to be a certain point. You cross, you're 40 years old, dude. They don't give a shit.
Yeah, it's not that cool of a story anymore.
No, you're just an old man trying to figure it out.
I'm about to get there. Like, yeah, my story's been cool for a decade. Like, in 3 years, like, okay, like I'm just another 35-year-old that's doing well. Like, you know what I mean? Like,
Absolutely. Absolutely. Yeah.
That's funny.
Yeah, we just had that same conversation. I mean, same thing, just smaller scale, but it's like, you buy your first house at 21. Oh man, that's great. You're 41. It's like, dude, you should have been doing this a long time ago.
Yeah, I know. The biggest thing is just starting early as you can, because compounding, the biggest part of the formula is time. So starting young is so important. So important.
When you were preparing to make those phone calls, was there like a necessary pitch, or was it more so I'm just a young guy that I want to learn, or here's what I'm looking to do? Did you have like an actual formulated plan when you were calling these guys, or was it literally just trying to get on the phone with them?
Yeah, just get on the phone, and then it was literally like, I'm Andrew Abernathey, 20 or however old I was, 19. I literally just want to learn. Like, I'm not here to do anything other than just like learn, love to hear your story. I just want to be in a room with you and just kind of absorb as much as I can.
Sure.
And that was about it.
And at that point, I would imagine with your charisma and with your knowledge, some of these guys might have offered you actual positions.
Yeah.
And did you ever get to a point where you've turned down positions, or you kind of bet on yourself opposed to doing the 9 to 5?
Yeah. There's been some situations like where 100% I could easily be a fit for a chief investment officer or something for someone. But again, I've worked for myself since I was so young. And I did catch a lot of traction at a young age that I never even, it was like a second thought, but then it's like, if I would have started later, that would have been a lot more tempting. I started this before I had kids and a wife and all the things that bring like, well, I better not do this, it's too risky. It's like, by the time I had a whole life and at this age, it was already worth 15, 20 million. So like, I never thought too much into it. That's for sure.
Your time and your freedom is worth. It's priceless, essentially. You get to that level. But yeah, you're right. You have to get to that financial point before you're like, okay, I'm not even going to consider it anymore. So I mean, even Ben talking about, it can be difficult. If you got something that's stable, or you wait too long, or you got the family with it, and it's like, then it's almost impossible.
Yeah.
So you do. It's the earlier you can start, it's like you almost can't stress that enough.
Yep, that's like the 80,000. I'm like, well, if I lose it, whatever. I'm 15.
I didn't have anything to begin with, so
I'll be just like everybody. I had $6,000. I know I started with 4,000. I had 6, but I bought a $2,000 red go-kart. So like I had that. No matter what happened, that was not collateral on any loan. I'd still have my red go-kart.
So then once you finally had some capital, now you're in your 20s here, then you started to deploying it into, was that storage? Is
Not
that
quite
one storage, or what were you doing in that period of time then?
Yeah, so that was kind of my years of, my mistakes in those years was, I had too many cups, companies, investments, not enough water, money. I would never fill a cup to its full potential before I introduced a new cup and started putting water into it. So I had all these cups that weren't fully filled. And we were doing good, but we're not doing great. I took control of an insurance company on the NASDAQ when I was like 24. I got on the board of I was one of the youngest guys in a public company board next to Evan Spiegel and Mark Zuckerberg. I had to get an exemption in Alabama to allow me to join the board at under 30. That was just a wild experience. We ended up selling the company to a private buyer, did well on it. So great experience. I bought a lot of real estate downtown here back in 2015 and 14 before the RDO building went up. Did really well on that. Now I got one of them back, but still, even net of that, I still went really well. I made a really big mistake though in those years. So, I had all these wins, right? You had the stock market win, these apartment wins, these buildings down here win. And not saying I was like full of myself, but you're young, you have 4 big wins. You're just like, okay, like this is great. So I found this helicopter company called Bristow, public company. It was a multi-billion-dollar company. Well, when the oil prices tanked in like 14-ish, 15, the stock went down to a couple $100 million market cap. And it was over depreciating their assets. So their book value was not accurate based on intrinsic value. And so shares were about $12. Holdings at that point was worth about $20 million. So I put $1 million in. It went to like $18 or $20 in no time, like 9 months. I made just about $1 million profit in no time, sold it. Sounds good so far. Mm-hmm. But then I look back 6 months later and the stock was back down to like $11. And did my research again, like the same company, same thing. So I put $1 million in, went to 10, put $1 million in, went to 8, put $1 million in, went to 6. And there was this big announcement they were going to be acquired. And I'm like, cha-ching, right? Like, perfect. Before the deal was closed, there was news that came out that the management was mismatching engines and helicopter bodies. So the deal blew up. They voluntarily did a golden parachutes out, bankrupt the company, that $50 million in the checking account, and they voluntarily missed a $20 million interest payment, and went to the banks. The bank sold it for $2 billion within a year. All the equity was wiped out, including us.
Dang.
And so what I learned from that, because at the end of the day, I'm in charge. And what I learned was I underwrote the business right. The numbers were right? They went and did what I knew it could do. But what I misunderwrite, what I didn't even underwrite was the people. I mean, people that run the business, especially if you don't have control, is so important. And I did not underwrite the people. Didn't even think about it. I was just so into the numbers. And so we lost $3 million there, which was about, easy math, 15% of our company. And the problem was that was all of our cash. And so we were in a huge cash crunch. And that was a stress. That was the start of a stressful few years of the company.
What years was that?
This was back in 2017, 18.
Okay. And it took a handful of years to dig out of that, 2 to 3 years?
Yeah, so I had, that's when I remember I got the news of the bankruptcy. I was hosting my family in Fargo for Thanksgiving, had my first kid. I just remember I was like white. It's like a ghost. And I just remember being on my knees, like, the self-doubt sets in, right? Like, I'm not that good at this. Like, this is all luck. Mm-hmm. What the hell am I been thinking? I'm an idiot. Just like everybody has those days, right? Where you're just like, I need to fucking quit.
Yeah.
Right. So I remember I gave myself like 2 days or 3 days to be, for the pity party. I remember that. So after those days were done, I remember talking to my dad, and he's just like, this is the moment where men and boys are separated, and you have to decide which one you want to be in life. Like, it's your choice. And that's all I needed. And so I started to assemble a plan. The first thing I did was my shares were worth about $3 million at the time. And I remember calling a investor of ours from Bismarck, and I just said, like, hey, I need a personal loan for $1 million. I'll give you all my shares as collateral. So 300% collateral, $1 million loan, 10% interest. So he gave me the loan, and then I loaned the $1 million into the company at 0%. So I ate the interest, got the company the cash it needed. That got us through. Eventually paid me back with no interest. I ate the interest, paid back, and everything was fine. And that was how we got out of the mess. A few other things, obviously, but that was the gist of it.
Yep.
But there was a lot of things that came from that, because that was a point, too, where I raised a lot of money from family and friends. So you have all these family and friends that buy into you young, and your identity is now the company. I don't remember before I was 15. So I remember my value to people being how much I make them, right? So I had an identity crisis, too. I had a handful of people out of the 100 some of the time that basically turned their shoulder on me when this first loss happened. So our shares went from 30,000 to 80,000 to like 60. And I had this handful of people that were basically family. They weren't, but felt like family.
Yeah.
Just turn. And so it was just a really hard few years. Emotionally, mentally, financially. Yeah.
So backtracking just a little bit here, just for the viewers. So you're throwing around a lot of numbers about you've raised this much capital. You've got a lot of big guys here. So can you break down this structure of Abernathey Holdings just a little bit?
Yeah.
And then the other question that I have, just top off my head before we get into that, and maybe this plays into the question. So how do you get paid?
Yeah.
You have a holding company, and you guys hold X amount of assets. You don't pay dividends.
Yep.
So where does your day-to-day living income come from? Like,
Great
how does
question.
this all play together?
So I'm going to go into that because Holdings, the structure is transitioned. So it started out as a fund. And so in the fund days, that was up to 2019-ish. It was a fund. That was a simple 2% management fee on raised capital. So if I raise $10 million, I get $200,000 a year. That $200,000 a year has to be for me and whoever else I need to hire to run the thing. So that was my income. And then there was a 20% profit share of anything above a 6% hurdle. So all the investors in Holdings get their money out plus 6% compounding. Anything above it, 80% to them, 20% would go to me. So that's how it went for the first while. And then in 2019, the secret to Berkshire Hathaway and Markel and all these groups that have built these huge businesses is permanent capital. That's why Buffett wanted to be public, because he wanted a permanent capital C corp that he could take to the next level. People could buy and sell shares, and the company won't be affected. So I changed it into a holding company. I actually I did not take my 20% profit share. We did a optional tender offer in 2020, we ended up buying back 10% of the shares, units, or an LLC, we call them shares. And I forgoed it was like a $2 or $3 million profit share I should have gotten. So I didn't take that, and I switched everything to a company. So now we have a board. So we have a 7-person board. I work for them as the CEO, chairman of Abernathey Holdings. They set a salary for me now. So I just signed a 10-year deal last year, and that's simply a salary. I don't get any profit share. I don't get any bonuses on value, because at the end of the day, I own 30% of the company today. And so I have enough incentive on that. So that's the structure where we've been, where we're at. We're still an LLC. We do need to switch to a C Corp soonish, I think. The biggest issue is we're an LLC still, but these K1s are over 10,000 pages because we have so many shareholders. And people now, we don't get our K1s done until June, July, obviously, because it's so much. Some people aren't liking the whole extension on the tax returns things every year. The problem is we go to a C Corp, the disadvantage is we can't do the pass-through depreciation to our shareholders. So that's why I've been delaying that decision. And when you have 150 plus investors, some of them are like, keep giving me the pass-through. I do extensions every year, so I don't care. You got some investors that are like, I don't care about the pass-through because it's passive to me, not active, so I can't use it anyways, and I don't want to do extensions anymore because it delays my refund.
Yep.
So it's tough. So we have to become a C Corp anyways to go public, but that was a rabbit hole. That's kind of the gist of where we were and where we're at.
Sure. So the 30% that you're holding on, that's obviously a long-term play. You guys do go public. At some point, that turns into a tremendous amount of money, and then you can move that around as you see fit.
Yep.
But for the time, it's a salary. You collect your 30, you grow the business, obviously incentivizing for you. And then once you do go public, that's when that big hit will come next.
Yeah. And the unique thing, too, about my 30% is I've bought those units, it's an LLC, at the same price as everybody else over the years. So not one of them was even in the comp plan. So I'm really proud of that too. Is, we've been raising money, and I've literally bought that many shares personally through loans, using my shares as collateral privately. Like, I believe in the company that much, where I've been buying. I think I bought shares in every offering we've had, all 10 of them. And so the 30% I have accumulated has all been without any comp gift or bonus, which is pretty cool. And the other thing I'm really proud of is our overhead. Abernathey Holdings is a decentralized system. So we've got all these subsidiaries, which we've got mobile home parks, equipment dealerships, self-storage, some other ones I'm working on. And those are all run by different presidents that have been in those industries for 15 plus years. They have their own team. I set the incentive for the president. So at Holdings, we really only have 3 employees. It's myself, my partner, Matt Halverson, and Charles is our controller. We're going to need to hire a CFO soon. But our combined overhead at Holdings for lawyers and accountants and salaries and office is well below, I think it's below 1.3% now of market value. That's crazy. Like, we have 0 overhead drag, which is so rare. So that's pretty neat.
And you guys have 150 accredited investors right now, and is that continuously growing each and every year, or are you trying to keep that steady at that 100 to 150 mark?
It's actually decreasing. So what we're seeing now is these credited investors. You have a lot of people that came in way back, right, 2012 or before, and their shares have now over 10x'd. They put in 50 grand or 100 grand or 300,000. They're looking to retire. There's no dividends, so they're looking to retire and just trying to start selling a little bit every year. And you have these other big players that are now eating those up. And so our headcount is actually starting to decline a little bit, which is nice. But yeah, so it's been unique.
I feel like I hear that a lot, and we had even said that too. It's like you would probably almost rather work with 50 big guys than 150 smaller guys.
Yeah.
It's just less essentially people to answer to, less K1s to send out. And yeah, I suppose that probably makes sense.
Yeah, and then there's pros and cons. Like if you have too much concentration with investors, sometimes it's tough because then they try to have more input, and you're so fragmented. People are like, well, whatever. Like, I own a 0.01%, so there's more fragmentation there. So there's pros and cons. The other thing too is, like, done a lot of soul searching, and it's like, what is my why in life? Right? Like, outside of money and all these things. What is my why? And I spent a lot of work on this. I've simplified it down to a sentence. There's a lot of meaning behind it, but my why is I want to make as much money for as many good people as possible in this world. And that's why I want to go public. So there's 2 options here. One is I could get this thing down to 10 people, stay private, and not worry, that's that. But I feel like I'm doing disservice to like my big vision. Like I got a foundation. I'm big into charity work. So now it's like I want to be on the public stage, and I want to like do the right things, have a Berkshire Hathaway like a company to allow everybody in the world, credited and non-credited, with that at that point. And then again, I want to like encourage them to give back and do amazing things with hopefully the profits. That's the goal.
Yeah.
So that's kind of why I want to go public, because I do know probably be easier to not. But again, I think that would be against my real why in life.
Before we get too much into philosophy, just one more quick question on like the business structure itself here. So you guys you've bought in a bunch of different companies, whatever that may be. Are you guys continually doing like new capital calls when you come across a new business or a new property that you want to buy? Like, is that a constant, guys are still feeding in? Or is it like a guy gives you, $250,000 and he goes, that's all I'm giving in?
Yep.
Or are there mandatory times you have to pony up? I mean, because I'm envisioning you have notes on all of these properties, so they're probably not cash flowing enough to where you're making enough income to buy the next one.
Yep.
So like, how does that work when it goes, I've identified another property, we need to come up with another 5 million or whatever that number is. How does that structure work within the company?
So we've never done capital calls. So how we structure it is nobody has their PG on bank debt. I actually have my PG on all the holdings debt, and I get no fee for that. So I have 100% of the downside and 30% of the upside, which is crazy. Like my salary I get from the board doesn't even cover a fraction of what a PG fee would be. So I'm basically working free and having a cheap PG fee.
Yeah.
So there's a lot of kindness there. And then some of our JV partners on properties also have their PG on that stuff. So again, no PGs from our investors and holdings. The other thing too is we've done so many offerings. So when we do an offering, whatever, $50 a share they used to be, you put in 100,000 or 200,000 or $1 million. That's it. There's no calls. Your name's not on any debt. So we've raised money again in the past when we have a new division we want to start a capital. We just do a new offering.
Okay.
Our current investors get the first right. If they don't want it, we go to new people that have been knocking on our doors. Mm-hmm. So again, that's been really nice. I'm really proud of that too. We've never once done a capital call, not once. Wow. So that's pretty neat.
Yeah. I feel like a lot of guys, even on some of the local investments you get around here, it's like, okay, well, get ready, something's coming.
Yeah. And the other neat thing about holdings too is, syndicate deals, right? A general partner will find a piece of land. They will themselves entitle it. So they'll buy the land for $1 million, put a couple $100,000 in entitling it. Then they'll find a bunch of LPs, limited partners. They'll throw the land in there at $2 million. So that general partner already made $800,000. Yep. And then the general partner's construction company will build it and fee the LPs. The general partnership's management company will management once it's open. There's all these things that the general partner, before the thing's even open, they made a bunch of money.
Yeah.
And then if the project does really well, they'll make even more money on the waterfall and the profit share. And the LPs, if it does really well, are going to be stuck in that 14 to 15%. If it does really bad, they carry the bag.
Essentially, that's Enclave, Eagle Ridge.
Yep. And they're great groups. Nothing wrong. I love the guys. But our structure is so unique. We're like the Vanguard. Abernathey Holdings owns everything. It owns the construction company. It owns the management businesses. There's not one thing outside of holdings that Andrew Abernathey owns. And that's how our returns have been 20%. It's not because we're doing something crazy. There's no hands in the pile. Like it is, everybody gets a piece of all the verticals. And that's simple. It's simply that. There's no, secret sauce other than just sharing everything.
Wow. How did storage units come to be? I feel like that's a little bit of a rare thing.
Yeah, that's a big one. So
yeah.
That's when we really blew up.
That was kind of what took you to the next level.
Yeah.
And what was the initial deal that got you started? Was that in Fargo? Was that Arizona? What was that deal like?
For storage, it was an Arizona one. So I went right in. There was no test in the market on that one. I remember like 17, 18, after the Bristow stuff happened, Gary, my mentor, basically was like, Andrew, you're good at a lot of things. You're not really great at anything.
Okay.
And I'm
nice.
like, that was a fair point. I had a mediocre business. We were in a lot of things. I didn't have enough money to really be the best at any of it. And so I really went to the drawing board. And I went back a week or two later meeting with them. And I'm like, how about self-storage? Like at the time it was fragmented. It was all the drive-ups, like these big, beautiful public storage and extra spaces, similar to Marriott and Hilton, which is how he made his money. That year, they came out with a program like Marriott did in the 70s, where you could put their name on your building and pay them a fee. So it was the same thing as hotels in the 70s. And then affordability in America. Like storage is really just an affordability play in the big cities. I mean, we are 20 to 30% less than an apartment per foot. Our storage now is being visited once every week or two. Back in the day, it was once a year. So it used to be shit you didn't want. Now it's shit you need. It's like the closet. It's a kayak for the weekend, a bike for the weekend, ride around with the kids. So I went, and the usage too, 9% of Americans used storage in 2012. Now it's like 12.5%. Every 1% is crazy growth. And he's like, this is interesting. So we go fly out to Extra Space, which was in Salt Lake City, and Public Storage in California. And we're on the way back. He's like, I think this might be your $1 billion idea. So we land. I looked at all of our companies and holdings. And I'm like, what would be good for verticals? Like, what would play with this? And the equipment dealership played with it, right? We have our own equipment on site, water trucks, all that. I'm like, okay, I'll keep that. Sold everything else. Had about a $15 million cash pile. And then I went to work. 2018, I found a lot in Arizona, ran the 202 in Higley, bought it, and we built a $13 million state-of-the-art facility, public storage branded. It filled up. We're at 94% occupancy, quicker than projections. There was a lot of hard times in that. Like, think about going to a bank in your 20s. I was still living in Fargo, never developed anything, never been in the storage business. Hey, I need, a $10 million loan. So we finally got it done, but we had to really pull some strings. I mean, that was not an easy loan to get. So now they're easy, but
when you said you sold everything, so you went to all your current investors at that time and said, look, I found this $1 million idea. We're going to keep this Great Falls equipment dealership. You just have to trust me. And they just went, all right, sell everything.
Yeah.
How long of a span did it take you to liquidate what you had?
Half a year.
Okay. Wow. So it was quick then.
I mean, I sold all my real estate here in downtown. Sold the insurance company, sold everything.
Did you have a lot of people at that time that when you did sell out, they're like, man, we could cash out.
Yeah.
We're done. Or did basically everybody stay and was like, okay, you've got this plan. We're going to ride or die here with you.
That's when we did the optional tender offer. And so we went to everybody. We sent out a big letter basically stating like, hey, me and the management are going to keep our shares. We're going to stay in, just so you know. But here's an option. We'll buy you out. Here's a price. We'll appraise everything. And I think we bought back 10% of the company.
Okay.
And now, since then we've 5x plus, but it's been a great run. But it was nice. I felt like it was only fair to do a tender when we were going to transition from a fund to a company, when we were going to really focus on one asset class. Like, it just felt like the right thing to do.
Yeah, that storage does seem to be the play. I don't know anything about other markets, but even here, you just look at the simplicity of what an actual storage unit is. Easy. There's nothing to it. Easy. And it's like there's no maintenance to it. Especially in Arizona, you're not pushing snow, you're not doing nothing.
Yeah.
It's like, yeah, it is. It's crazy how much of a more daily use that's an interesting stat. People check it once a year. Now it's once a week. I didn't know that, but that doesn't surprise me. So
yeah, I see a huge, and I'm a big history buff. So you go back to the Habsburgs and the Dutch and the British and the U.S. and fiat, non-fiat currency. That's a whole rabbit hole we can go down. But I have this theory over the next 50 years from a macro level of these deficits in America. Like, the only way to get out of this, like every other country in the past, is to inflate our way out of it. And affordability is going to continue to be an issue, and the haves and the have-nots will continue to separate, which will be internal conflict, which external conflict will follow. And these are all parts of the stages. The only inflationary things in the U.S. right now are the deficits, deglobalization, lack of immigration policies are all inflationary. The only deflationary thing happening right now is technology, AI. I don't know if that's going to be enough to counteract all the other inflationary items. So I'm putting my chips on inflation. But if I'm wrong and it's deflationary, well, cap rates will drop and I'll just make more money. It's a win-win. If I just bet on deflation and I'm wrong, it's a win-lose. And so back to real estate, affordability's the macro level, what I'm looking at. And so storage, we are the 20th largest mobile home park in the U.S. now. We own 2,500 lots across the Midwest. Those are the things I look at from a macro lens. And I can go in deeper there, but that's the gist.
Yeah. How come when you're scouting for different areas as far as where you want to acquire storage units, why was it Arizona, and were there other parks that you were really interested in? Like, how do you even get the information that you need to feel confident in that market? To where it's hard because you're more local up here. So how did you find that information?
Yeah, great point. Gary taught me the model of his hotels. He had 5-step criteria. He got it so simple to find sites that a monkey could do it. His was traffic count and heads in beds next door and, all the things. He had CoStar, which you could go off, which is helpful. Be by an airport, all these things. So really, Gary just said you have to create a criteria and you can build them anywhere, right? And so we were looking in the Minneapolis area. Arizona is a place that I've been going to since a kid. Family's always had a place there for the winter. And so it was always kind of a second home. Mm-hmm. And it was growing really fast and had all the things that were exciting. And so, but now we've got it down to a simple criteria. It's, we need 80,000 people in a 3-mile radius, because storage is a 3-mile radius business, and or a 15-minute drive, depending on how big and dense your city is. And we need 80,000 household income. We need a certain percentage as renters to owners. We need no more than 2 turns into our lot. We need so much square feet per competition next to us, no more. Certain rental rate with a good trend. And then now with AI, we've created some really cool stuff in-house. I mean, right, we have AI agents now in-house. Our land team's 1 person, and we're building we've got a couple $100 million in our pipeline just in our storage business. And every night, our AI agents, one will underwrite or find all the sites in America that are just listed. Then it goes to the next AI agent, it'll underwrite it. Then it goes to a zoning agent. By the time our land guy wakes up in the morning, he's got an email with the best sites in America and a one-sheeter for an investor, an IRR, and everything, an underwriting agent. I mean, we've been really going all in on AI in-house, not just for AI's sake, but for real efficiencies.
Yeah. It's funny, you hear a lot of people, I mean, even guys like us who we like to think we kind of know what we're doing sometimes, but it's easy to overthink, like you just got done saying, what are you looking for? But you break it down into kind of 5 or 6 simple things. It's like, okay, maybe it's not as much as you're making it out to be.
Yeah. But
it's hard for like a guy like me to imagine, who's basically all in on the Midwest, Fargo, Red River Valley, I'd say, to even be more specific. And the thought of going out somewhere that I don't know anybody and I've never lived there, it's just hard. That's a hard concept to grasp. I mean, it's like the control aspect of it, of like, well, here I can physically touch it, I can look at it, I can go to the site every day, I can be there to manage it. But, somewhere that you don't know, it's like, well, shit hits the fan, I'm gonna have to live there. I have to live in the storage unit,
I think the biggest thing too is like, it's really setting a team up of owners. Like Gary thought, I mean, at the end of the day, like your incentive program is everything. So for our presidents, I keep it pretty simple. So like for our equipment dealerships, the average, and I always do return on tangible assets. I don't do revenue, because you could have shitty revenue with low margins. I don't do return on equity, because you could over leverage it. I do the EBIT to total tangible assets. In the average business in America makes like 12% return on total tangible assets. Normont, the equipment dealerships make about 15% is the average. So what I do for our president, simple, here's a base salary. Anything above average, you get 10%, Holdings gets 90%. It's that easy. When you do it on that, he can't screw with debt. He can't mess with depreciation, because it's a 3-year rollout payment plan. There's no incentive to sell shitty business. There's really no incentive to over inventory and have bad inventory turn and a bunch of hard assets sitting there. So he's incentivized to only keep money that he can put to work. And at a 15% return on assets with 30% leverage, we're making 29% return on equity there. And if he can't, he sends it back to me in Scottsdale. So for me, I know when I need to buy a new company is when my cash pile gets too high. I mean, we were at 50% cash, our holding company, back in 2020.
Jeez.
So that's, the incentive programs are big. Another good one is Trammell Crow. He's a developer from the 80s. He wrote a really, really great book. It's like $300 because he didn't make many of them. It's about the partnership model. So if you have nerves about going into a new market or whatever it was, he would just find local partners to partner with in local markets, boots on the ground. So there's so many different ways to scale without the scare. And that's what I learned through. Those are 2 examples.
So what are some new things that you could give us a sneak peek as to what Abernathey Holdings are looking to acquire at this time?
Yeah. So one I can't speak much on, but one I can. We're looking to get back in the insurance business. So, Berkshire Hathaway, Coke can make 8 to 9% a year. So Coke in 1980s, when he bought it, they were and still are to this day doing 32% return on tangible assets. It's a beautiful business. He bought it at 3 times book. Now it sells at a little over 10 times book. So the going in returns are much different. Back in the 80s, interest rates were so high, multiples were compressed, and vice versa today. And that's also why he's sitting on $400 billion in cash, because right now what you can get in a risk-free bond doesn't pencil out to what you have to pay for the stock market. It just doesn't make sense. It's kind of like 1969 right now, where what I mean by that is the market average is 8%. 4 times in history, there's been a decade it's 13, 14% annually, and the next decade it makes 3% or negative, and that's inflation adjusted. My thought is in the next 10 years, we're going to go into, I think the market over the next 10 years will do 0 to like 3%, personally. Because at the end of the day, 20 years, it's going to do what it always does. But anyways, so this insurance company, the secret is he can buy a share of Coke, you make 8%, he'll make 15%. Because 30% of everything he buys is float. Float is 0 cost or negative cost if you have good underwriting. It's money that's not yours. So if you write a premium on your house for $100 and it goes to an insurance company, they sit on that money till all the claims come in. So easy math, it's called a combined ratio. So if you have 100 million come in as premiums to an insurance company, their underwriting loss is usually 60%. So 60 million of the 100 will be sent out as claims eventually. Then 30 to 40%, 35% is your underwriting costs. It's your employees, your desks, your overhead. So their combined ratio, you add the two together, it's 95 to 100%. Even at 100% though, you got to sit on that $100 million at no cost. It's like going to the bank and be like, give me $100 million, give you no interest for 3 years. It's basically what it is. And so that's what Buffett did. And that's how he's able to have exceptional returns on boring investments without risk. So when I'm at the point now is you get a company now worth $250 million. How do you keep finding great deals at that volume and more volume? Back in the day, it's easy to find deals because you're managing so little of money, and more money is an anchor to returns. So instead of trying to find needles in the haystack, what I wanted to do is rethink the capital stack. And that's what he did. So we're looking to acquire back the insurance company, that one we sold or another one, bring fully in-house. The secret, though, is the average insurance company has about 30% equity to book, which means the regulators, they require them to put it in CDs, bonds. Well, if you're making 3% on your float and you have a combined ratio of 100, which could be 105% if it's bad storms, if you underwrite badly, that's a shitty business. Nobody goes to the store and asks for your insurance. Nobody goes to your agency. It's like nobody goes to the store and asks for Abernathey farm bread. Yep. It's a commodity. But what Buffett did is he put his equity at 50% in his insurance company. He overcapitalized them. CNA did it. Markel's done it. Now actually Bill Ackman's doing it with his Howard Hughes Corp. They can now invest that float in whatever they want, or a good majority of it. That's the secret. And when we owned that insurance company before, it was too big for us. But now we can afford it and have that ratio accurate. So I want to bring that back in. And that will then increase our returns. Because if our general partner capital in deals with JVs is now funded by float that's not ours, now it's infinity returns. And there's no risk aspect here either, other than bad underwriting.
Wow.
So that's one thing we're getting into. And the other thing is tokenization. I'm not a believer in cryptocurrency. I'm not a believer in gold. I'm not a believer in the dollar. Currency was invented to eliminate the time it takes to barter. That's why it was invented. Speculation and investing are two different things. If you buy something like gold, if you buy all the gold in the world, it'd be a 68-foot cube. That's how much gold's been mined so far. And in this market, it's gone up so much now, but that's probably worth, call it $10 trillion. So if I gave you $10 trillion, you could buy all the gold in the world, put it in your backyard, you could hump it, kiss it, do whatever you want with it. But you own it all. Mm-hmm. Or you could buy all the farmland in the world, 4 Exxon Mobils, an Apple, and have a few $1 trillion of walk-around money still. I'd pick the latter. Because how you know if something's an investment or speculation is you shut the market off for 100 years. Speculation you can't do anything with. It doesn't produce anything. You only make money if you sell it to somebody else. And that's speculation. I only invest. So I don't believe in crypto and currencies. But what I do believe in is a blockchain. I think the blockchain has value. And what tokenization is doing, there's about $4 to $8 billion right now tokenized. And it's basically like taking a building like that we're in now, mm-hmm. and instead of putting it in an LLC or a C Corp and issuing shares. So if you put this building in an LLC, you have 1 million shares or units, and you buy one, you own 1 million to this building. But it's an LLC, you have the paperwork, the closing, all the things that go with it. Blockchain tokenization is I can put 1 million tokens, I can wrap it with tokens, and if you own 1 token of 1 million, it still represents a hard asset. It's a real thing. So instead of Holdings having 2.5 million shares issued, we could have 2.5 million tokens issued. It represents the same thing. The benefit of tokenization is no centralization. I mean, the NASDAQ and all these companies, they charge large fees to be public. And when tokenization, you don't have that. The other thing is 24/7 closing. No friction costs, no closing cost issues. So there's all these values. I see that as where it's going. Now, being early is wrong. If nobody uses it, it's worthless, like a fax machine. The other thing, too, is tokenization is not good for something like a holdings company. Holdings should go public the normal way. But what it is good for is our portfolios. You know, we have storage portfolios that are ballooning into the hundreds of millions. We have mobile home parks doing the same thing. My goal is to not sell those off. I do want to recycle our capital because our money at Holdings needs to live in the development stage because we need our return on book to be 30+% to earn the multiple on our shares. If we make 12%, our shares don't deserve a multiple. But I also want to keep control of it. So what I'm going to do is, and it's nothing new, is I want to sell the assets into a REIT that we control, and then we get that AUM fee. So if we own 5% of the REIT, but we're getting a half or 50 bips asset management fee, our return on our investment's 25% a year before even the economics of our 5%. But I want to go a step further, and I want to wrap that with tokens and tokenize it to even have it more efficient. And I think there's going to be about $36 trillion of tokenized real estate assets by mid-2030s.
And that's a new concept?
Yeah. Yeah, very new. BlackRock's been doing it. I mean, it's very new. So say by the end of this decade, I'd like to really play on maybe tokenize a couple $100 million in real estate of ours that's going to be stabilized, because tokenization is good for stabilized, predictable cash flowing. So, you know, we're not going to put a development play in there. It's going to be when they stabilize and we're ready to roll it off, recycle our capital, but keep the AUM control.
Wow. That's nuts. I've literally the first time I've ever heard that term. So
yeah, it's
cool.
a new one.
I got some YouTube watching when I get home.
Yeah, and I think and again, I'm always pivoting, but like right now, that's kind of what I've been hot in the trot on, because it makes sense. I mean, I'm in a farm boy. Just common sense is the best, and like, that makes sense to me, you know. So I'm excited about it.
So what just real quick, what does the personal life look like? We've talked a lot of business.
Yeah.
How do you manage? I mean, clearly you got a lot of people you're answering to, a lot of investors, a lot of great ideas, and a lot of deals that you're pursuing here too.
Yeah.
What does normal, like, day-to-day life look like for you? Like, you're a North Dakota farm guy, you're in Scottsdale, you said now. I mean, what does that look like? Yeah,
so I got 3 beautiful boys, 4, 6, and 8. Like, I'm not perfect every day. You know, sometimes you're present, but you're not present. Especially when I'm in my 20s, I've had to kind of learn and evolve my emotional intelligence. But I am a really good dad. And so I'm busy a lot, but I do try to be with them as much as I can. You know, my wife and I have 10 years. We got divorced last year, so that was a really tough year. And she's great. We're great co-parents. You know, we're 50-50. We don't live far from each other in Arizona. You know, we got married really young, and it just sadly didn't quite work out. But so I'm only with them, sadly, half the time. And when I'm not with them, I'm still out, obviously, if there's an event or something. But that really lets me cram work and meetings and travel and all of that in that 50% outside of like an event. But my days are really sporadic. I mean, I literally work from my phone. I don't even have a computer. I have a phone and like an iPad. I'm just always places. You know, I break off to do emails. Like after this, I'll spend 20 minutes, get my inbox to 0. Do a phone call to the next, you know, but I try to keep my schedule pretty empty because the day does just fill. Because I also don't want to be the guy that's like so busy I never get the time to think. Like if you go back in history, these guys, the Rockefellers, and I met so many billionaires now that I'm fortunate to kind of see the similarities. Like they don't have crammed schedules. Like they literally have a lot of time to just think. And most of the money is made in that thinking process. So I try my best. Obviously, I'm not perfect all the time. Every week looks different. But between fitness, I try to balance my 5 F's. You know, success is not just money to me. It's family, fitness, friends, faith. I missed one in there, but it's okay. It's too many. So kids first, family, friends. But what I do is basically my hobby. Like, I love what I do. So this is what I do when I'm not doing the other things. This is the best.
It's a great schedule to have there. Yeah, you get a lot of guys that are like, I'm jam-packed, but I love what you said of sometimes your most productiveness happens when you're like, kind
of bored.
Yeah, I could just like think about what I'm doing next.
yeah, that is the best. And whiteboarding. And I think knowing how you learn is important. Like I do probably a book a month, but it's Audible. Or I do a lot of documentaries. I'm a visual and listening learner. I'm not like a reader. I just get too sidetracked. So like learn how you learn young, and make sure you like keep yourself in that zone. I see so many people that are trying to be something they're not, and they find out at 50 like, oh, I learned way better visually. Like I wish I would have known that when I was younger, because compounding your knowledge is just as important as compounding your money.
Is there a piece of advice that you can remember from whether it's a Gary or another very successful person that you specifically remember that was like a turning point for you?
I think the biggest thing was like, sticking to your knitting, and like you're good at a lot of things, you're not great at anything, was just that really hit, right? Because like you have so many people, and I'm guilty of it. You get that entrepreneur bug, you're all cut from the same cloth. Like there's a million businesses that I'd love to be involved in, right? And me learning to not introduce a new cup before I efficiently built and set up as a company the prior cup. I've never built a business around me, because I have some of these friends that are like, this business has gotten really big and I can't leave it. I'm the CEO. Like I built it around me. I've never done that. And that's been a benefit of mine. Because once a company's set up with the president, it's on autopilot, and then okay, what's the next thing? What's the next cup? So I think that's really important. If you're going to run a business and be involved in it, you should have one cup and go all in, stick to your knitting. If you're able to do what I've done and decentralize it, that's okay to do more cups, but make damn sure you fill the prior ones and make sure they're not starving before you bring in a new kid. And the reason I say that is because if you're in a business, you don't have the time to do the research and study on the macroeconomics and microeconomics of a new industry. So don't lie to yourself that you can when you're in a business, working it day to day. I think you'd fall short is my view.
Yeah. So what would you say to someone, let's say someone's in their 20s and they're listening to this and they want to be like you. They want to do what you do, but they haven't had the early success story like you had. Yeah. What should they be doing today to get into a position where they could somewhat compare to where you're at today?
If I was starting over today, I think the best, you want to find how can you make good returns on low capital intensifying businesses. That's how you make your first million. And what I'm about to say might not be your $1 billion plan, but it's what's going to get you to $1 million, which then gets you into a different room. So I think there's a lot of arbitrage in AI right now. What I mean by that is you can go build a website now with AI and some freelancers, and you can do it for a fraction, but everybody else is still paying 15 grand, or marketing, or consulting, or whatever it might be. There is so much endless opportunity right now with AI. So learn AI, figure out how to do a $15,000 to $20,000 thing for nothing with it, which I know there's ways to do it. I've seen it already. Go and do as much of that as you can. And I bet you can start bringing in $250,000 to $300,000 a year within a year or two if you do it right. I've seen it actually personally 4 different times.
Wow.
That's what I would be doing. And that's how you make your first $1 million to $2 million. Now this arbitrage will only last so long. I don't know the math. I don't know exactly. I mean, humans are pretty slow to the punch when it comes to technology. So like maybe you got 5 years, could be 10. But 5 years, you make a few $1 million. Like now you are ready to go to the next stage.
Wow.
So that would be my advice. I think that's like the low hanging fruit currently. Pre-AI, I would say go buy, instead of putting your $10,000 or $20,000 into the stock market making 8%, put $20,000 into 3 pressure washers and start pressure washing buildings. You'll make 100% return on your time in that equipment in 6 months. Like you can make way more money in returns when you have less than $1 million doing stuff like that. Like I just don't think a stock market's the place to be if that's your goal. I mean, if your goal is to have a 9 to 5, retire, like that's fine. I really tell people to start with the end in mind. Like before you even start, what do you want your net worth to be when you're older? There's no wrong answer. What do you want your life to look like? What do you want your risk tolerance to be to get there? Figure that out. Because if your answer is I want to be worth $3 million or $4 million and retire when I'm 65, well then shit, you do the normal thing. That's all good. Like no harm, no foul. Yeah. Love it. Be happy. But if you want to be worth $100 million, well then your plan that I give you is going to change based on your end goals.
What about risk tolerance? You bring that up. That's something where someone might be listening to this who is maybe in their 40s, 50s. They've done the 9 to 5. They've gained their 8%. They have a couple $1 million in the bank. They're like, this guy, he's great, but he's too risky. He's too risky. What would you say to that? And how did you learn the level of risk that you could take? And how long did it take for you to recognize that about yourself? Yeah,
so like my risk really dropped. I mean, already, when I was starting out, I would be way back. I would have basically 100% leverage on a bunch of stuff, and it was just different. Now, we put 40% cash down on real estate. We have no mezzanine debt. Like I issued shares and holdings and I diluted myself because I didn't want the debt. I didn't want the risk. So like now I'm in a place where I'm like, no storm, we're good. Like now I'm just on the simple, like make 15% compounding-ish and life is great. But going back, I mean, yeah, there's a risk, you know? I mean, easy math, if that guy that has $2 million, he's making 8% in the market, he could go buy a stabilized real estate property, have decent leverage, no risk there, and he might make 11 to 12% over time with cash flow and appreciation and debt pay down. So maybe he can make an extra 4% annually, which adds up over time. But then you've got, if it's just one property, he's probably going to be running it. It's probably going to be, well, that's pretty concentrated risk. You can't like buy 100 of them. So that would be one of the things. Development is where you make the 18 to 20%. But again, a lot more risk if you don't do volume, you don't have volume discounts. So I'd say something like that would be try to find, and again, if his goal at 50 is to be worth 20 plus million, he's worth 2 now, there's no magic bullet where it's like a guarantee and no risk. Like people get to where they're at because they got big kahunas, you know, big balls. So I can go down a list of investments and I can rate them riskiest to non-riskiest and potential returns. At the end of the day, if you want no risk or low risk, bonds, 4%. If you want a little risk, but not much, general market, NASDAQ, make 8%. You start climbing that ladder on returns, just what comes with it.
I got to ask you one more question before we go here. So as far as drive and what drives you, obviously that changes from when you're 15. Because when you're 50, you get a nice car and you're like, oh, sweet, life's good. Then 20, you get a nice house, you're good. And it just like, it keeps changing. I've always wondered on how these millionaires get to a point to where they can continue that drive. Like you still clearly have the drive of a 21-year-old.
Yeah.
How do you keep that drive? And do you think it's similar in what other millionaires and billionaires are doing? Like, how did you model that?
Knowing myself and learning a lot from different billionaires, people that are worth even 500 million, what I learned is that people that go past 100 million, that they really love the game. It's not even like I just wake up obsessed, and so do they. Anybody that's doing this for the money usually stops around 100.
Yeah.
So anybody past 100, there really is no secret. It's just people that literally this is what they love.
Did you have that when you were like, let's say you were 25? Did you have like, man, once I get a brand new pickup and a nice house, like I'll be good, and then it just changed from there? Or was that never the goal? Like it never even really crossed your mind of having nice things? Like
money was instilled this day. Like my net worth and my lifestyle are totally different. And the biggest reason is my net worth is shares. There's no dividends, and I get a salary that gives me a decent life, but I don't have any jets or anything crazy. Like it's pretty basic. So I guess I've never even had the choice to get too crazy unless I sell shares, but don't want to do that. But I've also never, like my why has never been really about the money part. Like I do love nice things, like nice supper here and there. I do some charity events. Like I do enjoy it, right? There's things.
Of course.
But money is not fulfillment, right? And I knew that from a young age. Like fulfillment comes from other things. Money's a magnifying glass. Like if you're an asshole, you're just going to be a rich asshole. If you're a nice guy, you're going to be a rich nice guy. You're going to do more of what you already are. And so for me, and it's funny too, like I like govern myself. What I mean by that is like, I told myself I can't do this until I'm 35 because what else will I look forward to? Like I have things at different metrics of my life that I'm going to allow myself to do when it comes to personal luxuries, because I'm afraid if I do it too early, I'll get sucked into the luxury. And then if you do everything by 40, then what? How about the rest? How about the next 60 years or whatever we can live to with technology? Yeah. So to answer your question, like it's always just been about the next deal. I will sacrifice all the nice things in my life to do another deal. Like I'm obsessed with investing. Yeah. I drove a 2001 Subaru until 2021, 250,000 miles on it. Pulling up to banks, getting $10+ million loans. I ain't give a shit. Pulled up to the president office, like, car was $2,000. Just that's just how it was.
That's awesome. Is there any last little bit of advice you'd like to give before we sign off on here to any young guys?
I think the biggest thing is like everybody is always looking like for the idea. Like they're sitting around for that. And what I want to tell people is like there is no the idea. Like there's a million of ideas. You grab one, you make it the idea. The world doesn't know what they need until people like us tell them. And so that's just my biggest thing is start. I didn't know what a PPM was until I said I'm going to raise 10 million. I went to the lawyer's office. I didn't know what a purchase agreement was or escrow was until I got into a contract. Just learn, pivot and learn. Billionaires make 10 or 15 times the decisions daily than the average person or something like that. And when they may have a failure, they move on. There's no dwelling. If you dice up all the little efficiencies that these people that have big success have, it compounds over time, you know? Climbing Everest starts with one step. So I just say, like, just start.
Yeah.
Do not wait for the idea. Like, just find one to make it the idea. That's the biggest thing.
It's awesome. Appreciate you being here, Andrew.
Yeah.
Yeah,
Thanks for
thanks
coming on.
guys.
Thank
that
you.
was awesome.